Welcome to the research desk.
We have a really fundamental question on the table today, one that sits at the very foundation of how capital is allocated across the world.
We do. We are looking at the triad of asset pricing, specifically the idea of a hedge floor, an arbitrage premium, and a structural bid.
Right. And the central tension here is whether that triad is a true universal law of asset pricing, or is it merely a seductive vocabulary that shatters under the weight of catastrophe risk, illiquidity, and political rupture?
I strongly argue that this framework is the ultimate base layer map. It is the definitive lens for understanding why capital pays up for any asset. It does not matter if we are talking about public equities, sovereign bonds, hard commodities, or a completely opaque private markets.
It is an elegant framework, I will give you that. But elegance is often a trap in financial markets. I actually view this triad as an engineering model built on sand.
Built on sand, but prices are not random. Across all intermediated markets, prices reflect some combination of hedging demand, relative value pressure, and price-insensitive flows. When you strip away the noise of the daily news cycle, you find these three gravitational forces governing every major cycle.
It is a highly useful description for perfectly functioning markets during normal times. I agree with that. But it fatally blinds investors to tail risks, behavioral delusions, and non-stationary regime changes.
I completely disagree that it blinds investors. To understand why this framework is inescapable, we have to meticulously unpack the mechanics of each of these three pillars. We are not just throwing around academic terminology here.
Well, I hope not. Because treating this as a universal law is not just intellectually incomplete, it is actually dangerous to portfolio survival. When liquidity evaporates, the so-called structural bid vanishes, the arbitrage premium becomes a prison, and the hedge floor falls out completely.
Let us test that. Let us look at the physical laws of capital movement, starting with the first pillar, the hedge floor. It is the absolute foundation of downside resilience.
Most people hear the word hedge and immediately think of financial derivatives, right? Like buying a put option on the S&P 500 to protect against a market crash.
Exactly, but a true hedge floor is much deeper and more structural than a financial contract. It is any intrinsic characteristic of an asset that forces capital to step in and buy when the price falls to a certain level.
Give me a concrete example of that outside of derivatives.
Let us look at real estate. The hedge floor in commercial real estate is the replacement cost of the building plus the underlying land value.
So you are saying if an office building in a prime metropolitan area drops in price to the point where it is trading for half of what it would cost to build it from scratch?
Capital will instinctively buy it. Exactly. If it costs less to buy the existing building than to pour the concrete, buy the steel, and pay the labor to build an identical structure across the street, the replacement cost acts as a physical floor.
And you see this across other asset classes?
Absolutely. In commodities, the hedge floor is the marginal cost of production. If the price of copper falls below what it costs the most efficient miners to pull it out of the ground, they simply shut down the mines. Supply constricts, inventories drain, and the price is forced back up.
And in private markets?
In private equity, the hedge floor is the liquidation value of the company's assets, or the baseline recurring cash flow. Investors will reliably pay a premium for this structural protection. The market organically constructs a floor.
The concept of a hedge floor is logically sound in a vacuum, but you are assuming a continuous, frictionless environment. You are describing a world where investors always have the capital, the time, and the operational capacity to step in and buy that copper mine the moment it hits replacement cost.
They do, over a reasonable time horizon. But that is only the first pillar. If the hedge floor protects the downside, we have to look at what drives the active trading and valuation above that floor.
Which brings us to your second pillar, the arbitrage premium.
Right. Capital never evaluates an asset in isolation. It prices it strictly relative to its substitutes. The law of one price suggests that two identical assets should trade at the exact same price.
But markets are vast and fragmented. They are populated by human beings with different constraints, different tax treatments, and different access to information. These frictions prevent perfect efficiency.
Precisely.
If asset A and asset B generate the exact same cash flows, but asset A is trading at a 10% discount because it is listed on a less liquid exchange, what happens? Capital will naturally sell asset B and buy asset A. They are harvesting the arbitrage premium.
They are being compensated for providing the exact mechanism that brings the market back into equilibrium.
Yes, and this is not just a theory. Entire industries, from high-frequency market makers to massive statistical arbitrage hedge funds, exist solely to identify and close these relative value gaps. It is a gravitational force pulling prices toward mathematical alignment.
Okay, so if arbitrage is the gravity pulling prices together, there has to be a force pushing the overall market higher, irrespective of relative value. What is the third pillar?
The third and perhaps most powerful pillar is the structural bid. This is the force of price-insensitive, mandate-driven capital flows.
You mean money that must be deployed regardless of what the valuation models say?
Exactly. Think about the mechanics of a modern retirement system. Every 2 weeks, millions of workers receive a paycheck, and a percentage of that paycheck is automatically deducted and funneled into a 401k target date fund.
And that fund is legally mandated to allocate a specific percentage to the S&P 500, regardless of the market cycle.
It does not matter if the market is at an all-time high. It does not matter if the price-to-earnings ratio is historically stretched. That capital executes a blind, structural bid. We see this across all tiers of global finance.
Like central banks accumulating gold reserves, they aren't trying to time the spot price. They have a strategic sovereign mandate to diversify away from the US dollar.
Exactly. Or commercial banks buying government bonds? They do not do it because they love the yield. They do it because Basel III banking regulations legally force them to hold high-quality liquid assets to maintain their capital ratios.
So this structural bid creates a massive, relentless current of capital that dictates the primary trend of an asset class.
Yes. When you combine these three forces, the downside protection of the hedge floor, the relative value mechanism of the arbitrage premium, and the relentless upward pressure of the structural bid, you have the complete blueprint for asset pricing.
The blueprint is internally consistent. I will not deny that. But to test a structural blueprint, you cannot just look at an old established building where the concrete has been curing for a century.
How would you test it then?
You have to look at how capital behaves when a market is built from absolutely nothing.
That is precisely the test I want to apply. Let us look at a market that had to be constructed entirely from scratch, carbon credits.
The early days of the carbon markets were an absolute mess.
They were. Let us look at the early days of the European Union emissions trading system, the EU ETS. Initially, pricing was a fragmented, chaotic, heavily policy-driven anomaly. There was no clear price discovery.
Because governments were handing out emission allowances for free to protect their domestic industries, which led to a massive oversupply.
Exactly. The price of carbon effectively crashed to zero during the first phase. It was a purely experimental, deeply inefficient arena. But what happened as the market matured?
The regulatory environment tightened.
Think about this for a second. The moment that corporate net zero pledges evolved from voluntary public relations campaigns into strict, legally binding compliance mandates, the triad materialized out of thin air. First, a massive structural bid formed.
Because power plants and heavy manufacturers realized they could no longer lobby their way out of emissions caps. They had to buy allowances to legally operate.
They became price-insensitive buyers driven by compliance. Simultaneously, a hedge floor emerged. Because massive industrial emitters were now exposed to the extreme volatility of carbon prices, they needed a way to lock in their costs for the next 5 years.
So financial institutions stepped in, creating futures and options markets for carbon.
Yes, and the moment you have a deep derivatives market where industrials are buying long-term protection, you establish a definitive floor on the price. Finally, an arbitrage premium materialized.
Capital began looking at the price differences between the EU ETS, California's cap-and-trade program, and voluntary offset markets.
Precisely. Hedge funds built sophisticated models to trade the spread between European carbon allowances and the cost of European natural gas and coal. The market was born in chaos, but the moment it matured, the triad of hedge,
arbitrage and structural demand became the absolute governing dynamic. It is the inevitable destination of capital.
The evolution of the carbon credit market is a beautiful narrative. It perfectly illustrates how capital organizes itself when the regulatory environment provides clear rules, continuous liquidity, and enforced property rights.
Which proves the framework.
No, that beautiful narrative exposes the exact flaw in your premise. You are offering a pristine description of capital flow under heavily controlled laboratory conditions, and you are mistaking that description for a universal law of physics.
How is it a mistake? It describes exactly what happened.
I look at your triad through the analogy of a medical diagnosis, specifically the critical distinction between a clinical vocabulary and a true theory of disease.
Explain the clinical vocabulary analogy.
Well, a doctor can walk into a patient's room and perfectly describe the symptoms. They can measure the fever at 102 degrees, they can document the inflammation in the joints, and they can monitor the drop in oxygen saturation.
They have an accurate map of what is happening.
They have a flawless, precise vocabulary to describe exactly what the body is doing in that moment. But having the vocabulary to describe the symptoms does not mean the doctor understands the underlying autoimmune pathology that's destroying the patient's organs.
So you are saying my triad is just a description of symptoms?
Exactly. Words like hedge floor, arbitrage premium, and structural bid, or just a clinical vocabulary describing what capital does in normal, perfectly functioning conditions. They describe the symptoms of a healthy liquid market, but they fail entirely to predict the pathology of a sick one.
I argue the framework predicts behavior even in sick markets.
When the market breaks, the vocabulary remains, but the predictive power is entirely gone. You assume the triad dictates the market. I argue the environment dictates the triad. To prove this, we have to look at the exact mechanism of your second pillar, the arbitrage premium.
The arbitrage mechanism is mathematical. If two assets have the same fundamental risk and return profile, but trade at different prices, the act of buying the cheap one and selling the expensive one forces the prices to converge. It is the definition of market efficiency.
In the theoretical ideal, yes, arbitrage is a mathematical certainty that pulls prices back into alignment. But we must move from the theoretical ideal to the first major stress test of the modern financial era.
You were talking about the financial crisis.
Specifically, let us examine the catastrophic events of the second week of August 2007, widely known as the quant meltdown. We can look directly at the definitive post-mortem analysis conducted by academics Amir Kandani and Andrew Lowe.
The quant funds were running massive statistical arbitrage books.
To understand the pathology of this event, we have to break down exactly what these quantitative equity market-neutral funds were doing. These were the most sophisticated investors on the planet. They had massive supercomputers analyzing decades of historical stock data to identify precise factor relationships.
Finding that value stocks consistently outperformed growth stocks by a tiny fractional margin over specific time horizons.
Right. Because the spread, the arbitrage premium, was so incredibly small, they had to apply massive amounts of leverage to turn that tiny spread into a meaningful return for their investors. They were operating under the exact assumption of your framework.
That the arbitrage premium is an absolute law of value, a reliable gravitational force that can be harvested indefinitely. So what actually happened when the market opened on August 7, 2007? Think about this. There was no major macroeconomic news. There was no terrorist attack. The underlying businesses of the companies they were trading had not changed overnight.
Yet, the portfolios of these mathematically hedged funds began to violently implode. Why? Because of the hidden mechanics of liquidity and crowding. Months prior, the subprime mortgage market had begun to crack. Large multi-strategy hedge funds, funds that traded both mortgages and equities, started taking severe losses on their mortgage books.
And their prime brokers, the investment banks providing them with leverage, demanded immediate cash to cover those losses. Margin calls.
Exactly. Now, these multi-strategy funds could not sell their toxic subprime mortgages because that market had completely frozen. No one wanted them. So to raise the billions of dollars in cash they desperately needed, what did they do?
They were forced to liquidate the most liquid, high-quality assets they owned, their quantitative equity portfolios.
Here is the fatal flaw in your arbitrage pillar.
The multi-strategy funds were running the exact same quantitative models as the pure quant funds. They all owned the exact same undervalued long positions, and they were all shorting the exact same overvalued short positions.
So when the multi-strategy funds started indiscriminately dumping their long positions to raise cash, it caused the prices of those stocks to plummet.
Simultaneously, they had to buy back their short positions to close them out, causing the prices of those overvalued stocks to violently spike upward. The pure quant funds, sitting in a completely different building, trading entirely different strategies, suddenly watched their mathematically pristine portfolios explode.
Because the long positions they relied on were crashing, and the short positions they owed money on were squeezing higher simultaneously.
Positions that were mathematically designed to diversify each other, assets that had absolutely zero fundamental economic connection, began moving together in exact lockstep. The forced unwinding of identical portfolios by different funds caused a systemic collapse of the arbitrage mechanism itself.
You are describing a temporary dislocation.
Arbitrage is not a law of nature. It is a contingent capacity. It depends entirely on funding stability, deep market liquidity, functioning legal plumbing, and the political permission of prime brokers to maintain leverage.
But that does not mean the underlying value changed.
The academic work of Amihud, Mendelssohn, and Pedersen demonstrated clearly that illiquidity carries its own massive premium. The arbitrage premium you describe is not a free lunch provided by market friction. It is explicit compensation for the inability to exit the trade when the room catches fire.
The events of August 2007 were undeniably brutal. The mechanics of that forced liquidation cascade were terrifying for the funds involved. But a temporary dislocation in market plumbing does not invalidate the underlying framework of asset pricing.
It vanishes exactly when you need it most. When the margin clock calls, the arbitrage premium ceases to exist.
You are confusing a liquidity shock with a failure of valuation. Academic finance has not ignored the events of 2007. In fact, researchers have spent the last 2 decades refining these exact models to deeply account for the realities of market friction, funding constraints, and liquidity premiums.
Refining the models doesn't stop the plumbing from breaking.
Stephen Leroy's extensive survey of dynamic expectations models proves that asset prices reflect discounting frameworks that are constantly shifting. The models do not assume continuous liquidity. They dynamically adjust the discount rate to account for the probability of severe liquidity contractions.
So they price in their own destruction?
The risk of a margin cascade is priced into the initial arbitrage premium. Furthermore, look at the groundbreaking work of Damiano Brigo, Massimo Morini, and Andrea Pallavicini on counterparty credit risk.
The no arbitrage structures?
Yes. They demonstrated that even the most complex, friction-laden derivatives, operating in markets where counterparty default is a very real probability, can be mapped through rigorous, mathematically sound no arbitrage structures. They incorporated funding costs, collateral requirements, and margin calls directly into the valuation algorithms.
That is just adding more complex vocabulary to the symptom chart.
The framework is not broken by the existence of illiquidity, it absorbs it. What Condonani and Lowe documented in August 2007 was a highly localized failure of liquidity provision. It was a sudden, violent contraction in the arbitrage capacity of a specific subset of highly levered actors.
A localized failure?
It was a heart attack in a very specific capillary of the financial system, but it was not a failure of the underlying macroeconomic forces of valuation. The underlying companies whose stocks were being wildly thrown around still possessed their fundamental cash flows.
But the price did not reflect those cash flows.
That is precisely why the broader market absorbed the quant shock. Within weeks, fresh capital stepped in, bought the artificially depressed assets, and reestablished equilibrium. The law of gravity was temporarily obscured by a storm, but gravity itself never ceased to function.
You call it a localized failure. You call it a temporary storm obscuring gravity. I call it the defining characteristic of a financial crisis. If the model only works when the weather is clear, it is not a map of the territory. It is just a map of the sunshine.
It maps the recovery, too.
And if you want to dismiss 2007 as a localized subset of actors, let us escalate. Let us look at the ultimate undeniable kill shot for your arbitrage pillar. Let us look at the collapse of long-term capital management in 1998.
LTCM is the classic cautionary tale of leverage.
This was not a localized subset of anonymous quants. This was a hedge fund staffed by the absolute titans of modern finance, including two Nobel laureates, Myron Scholes and Robert Merton.
The exact men who wrote the foundational academic literature on options pricing.
They built an enormous, highly levered portfolio based on the absolute mathematical assumption that historical relative value spreads would naturally converge. To understand the hubris of LTCM, you have to look at the mechanics of their most famous trade, the convergence of on-the-run and off-the-run U.S. Treasuries.
The U.S. Treasury regularly issues new 30-year bonds. The newly issued bond is called the on-the-run Treasury.
Because it is new, it is highly liquid, and investors pay a slight premium for that liquidity, meaning its yield is slightly lower.
And the previously issued 30-year bond, now 29.5 years from maturity, is the off-the-run Treasury. It is slightly less liquid, so it trades at a tiny discount, with a slightly higher yield.
The Nobel laureates at LTCM looked at this and saw a perfect arbitrage premium. The bonds were both guaranteed by the U.S. government, they had nearly identical maturities, therefore the spread between them had to eventually collapse.
So LTCM aggressively shorted the expensive on-the-run bonds and bought massive quantities of the cheaper off-the-run bonds.
Because the spread was microscopic, measuring in a few basis points, they leveraged the fund massively, borrowing roughly $30 for every $1 of equity they had. They mapped this exact arbitrage premium across Italian government bonds, swap spreads, and mortgage-backed securities globally.
They built a supposed hedge floor out of pure mathematical correlation.
So what happened in August 1998?
The Russian government fundamentally defaulted on its domestic sovereign debt, the GKOs. Russia simply refused to pay.
Which was an unthinkable tail risk that the models had assigned a near-zero probability.
The global financial system immediately panicked. Investors violently dumped every illiquid, risky asset on Earth and frantically bought the safest, most liquid asset available, the newly issued on-the-run U.S. Treasury bond.
The spread between the on-the-run and off-the-run treasuries did not converge. It exploded to unprecedented levels.
The global flight to quality meant that every single relative value trade LTCM had put on began to lose money simultaneously. Global liquidity completely vanished. Correlations across entirely different asset classes spiked to 1. Everything crashed together. Instead of harvesting a mathematically guaranteed arbitrage premium, LTCM faced catastrophic margin calls from every major Wall Street bank.
The models dictated that the trades were safer than ever because the spreads were wider than historical norms, but the market refused to provide the liquidity necessary to hold the positions. The situation spiraled so violently that the Federal Reserve had to step in and organize a $3.6 billion rescue package funded by 14 major banks.
To prevent the forced liquidation of LTCM's trillion-dollar derivatives book from taking down the entire global financial system.
The failure at LTCM was not a lack of intelligence. It was not a failure to mathematically refine the dynamic expectations model. It was the hubristic, fatal belief that historical pricing relationships and arbitrage premiums remain available to be monetized under extreme stress.
But again, that is an issue of leverage, not valuation.
Your framework works exactly like a municipal electricity grid. On a mild Tuesday in October, the grid is a marvel of engineering. The voltage is perfectly regulated, the supply elegantly matches the demand, it is highly reliable under normal conditions.
And when the storm hits?
The framework is completely, devastatingly unavailable the exact moment a severe winter storm hits. Everyone turns on their heaters simultaneously, demand surges, and the infrastructure is actually tested. The transformers blow, the grid goes black. Having a brilliant diagram of how the grid is supposed to work does not keep you warm when the power goes out.
The LTCM narrative is entirely valid as a lesson in risk management. I will readily concede that massive systemic liquidity vacuums can temporarily suspend the arbitrage mechanism. When margin calls force indiscriminate selling, the relative value pillar buckles.
It doesn't just buckle, it shatters.
But this is exactly why the framework is a triad, not a single pillar. If a sudden liquidity freeze disrupts the arbitrage capacity, we must rigorously examine how the other two pillars, the hedge floor and the structural bid, hold up under that exact same stress.
You think the structural bid survives a crisis like that?
The power of the framework dictates that even if the arbitrageurs are temporarily wiped out, The fundamental, real-world demand for downside protection and the ongoing presence of mandate-driven capital will provide a deep gravitational pull that eventually restores order to the system.
You are relying on a delayed reaction.
You are pointing to incredibly rare generational black swan events, the 2007 quant shock, the 1998 Russian default. You are using these to disprove the everyday existence of gravity.
It is not just the sudden evaporation of liquidity that breaks this model. It is the fundamental structural nature of extreme tail risks. If your framework is truly the universal base layer map for all asset pricing, it should be able to effortlessly categorize any major institutional asset class.
It absolutely can.
So let us examine an asset class designed specifically around tail risk: catastrophe bonds.
Cat bonds are a highly specialized insurance product.
For listeners unfamiliar with the mechanics of this market, let me explain exactly how a catastrophe bond or a cat bond actually functions. Insurance companies like Swiss Re or Munich Re hold massive liabilities.
They write insurance policies for millions of homes in Florida against hurricanes, or in California against earthquakes.
The insurers collect premiums, but they know that if a Category 5 hurricane scores a direct hit on Miami, the sheer volume of claims would bankrupt the insurance company instantly. To protect themselves, the insurance company creates a special purpose vehicle and issues a catastrophe bond to institutional investors.
The investors buy the bond, let us say for $100 million. That principal is parked safely in U.S. Treasury bills.
The insurance company then pays a very high, floating coupon rate to the investors. It is an incredibly attractive yield. But there is a catch. The bond has a parametric trigger.
Meaning it is tied to physical data, not financial data.
Exactly. If a hurricane hits Florida and the officially recorded wind speed exceeds 150 miles per hour, or if the total industry losses exceed a specific multi-billion-dollar threshold, the bond is triggered.
The investors immediately lose their entire $100 million principal.
That money is handed directly to the insurance company to pay out the claims to the homeowners. If the hurricane never hits before the bond matures, the investors get their principal back, plus all the high-yield interest they collected.
Which makes it a fascinating mechanism for risk transfer.
Now, let us look at the data. Look at the comprehensive 2023 Aon report analyzing the Swiss Re Global Cat Bond Index. The statistical correlation of catastrophe bonds with the S&P 500 over the past decade is near zero, 0.05. It is essentially zero.
And the correlation with fixed income?
Their correlation with global aggregate fixed income bonds is exactly negative 0.02. Think about the implications of those numbers for your framework.
They move completely independently of traditional markets.
This asset class completely defies the triad. This is not a standard hedge floor based on the replacement cost of an asset. And it is certainly not a classic relative value spread, where investors are harvesting an arbitrage premium between two mispriced financial instruments.
It is the pure, unadulterated risk transfer of low-frequency, high-severity events.
Investors in the catastrophe bond space are not being paid a standard liquidity premium or an arbitrage premium. They are being paid explicitly for model uncertainty.
The actuarial models predicting the weather.
The insurance companies employ thousands of meteorologists, seismologists, and actuaries, running incredibly complex climate models to predict the probability of a catastrophic hurricane. The investors buying the bonds are being compensated for bearing the distinct, terrifying possibility that those actuarial pricing models are totally fundamentally wrong.
They are getting paid for the risk that the climate is changing faster than the historical data suggests.
This entire multi-billion-dollar asset class exists completely outside the normal macroeconomic market cycle that your framework desperately requires to function.
I will concede the catastrophe risk sits outside the traditional macroeconomic cycle, but it is an alternative asset class for a reason.
And if localized catastrophe risk sits outside your model, let us look at what destroys the model entirely on a global scale: geopolitical rupture. We do not need to look back to 1998. Look at Russian sovereign debt in the first quarter of 2022.
The invasion of Ukraine and the subsequent sanctions.
Before the invasion, Russian sovereign debt was considered a standard emerging market allocation. It had a clear yield, It had an arbitrage premium relative to other emerging markets, and it had a massive structural bid from global pension funds and index providers tracking emerging market indices.
Then the geopolitical reality violently fractured.
The implementation of severe, coordinated Western sanctions did not just widen the arbitrage premium, it permanently, irrevocably transformed the fundamental investability of the asset itself. Hedging the debt became legally impossible overnight because Western banks were prohibited from providing the derivative contracts.
The structural bid did not just weaken due to a shift in market sentiment. It violently reversed into forced, immediate, indiscriminate selling by every legally compliant institution on Earth.
The indices unceremoniously expelled the bonds. This was not a parameter shift inside an elegant pricing model. You cannot adjust a discount rate to account for this. It was a complete binary state change entirely outside the model.
When the political reality dictates that an asset can no longer be legally transacted or held by Western capital, the academic concepts of hedge floors and structural bids are instantly rendered meaningless. The asset effectively ceases to exist in the financial universe. The invasion of Ukraine and the subsequent sanctions regime were historic geopolitical shocks. Catastrophe bonds represent the absolute extreme frontier of institutional risk transfer. Those are genuinely extreme edge cases.
You call them edge cases, but they wipe out portfolios.
They are fascinating to study, but we must maintain perspective on the vast, overwhelming scale of global capital. The total market capitalization of global public equities is roughly $115 trillion. The global bond market is roughly $130 trillion.
And you think the triad governs all of it flawlessly?
For 95% of these massive, highly liquid, intermediated public markets, the triad of hedge, arbitrage, and structural demand remains the absolutely dominant gravitational pull. We do not throw out Isaac Newton's laws of classical mechanics just because we discover that black holes exist and violently warp space-time at the extreme, unobservable edges of the universe.
But the black holes are where the real risk is.
For the vast majority of assets, day in and day out, this framework holds true and dictates where the money flows. And to definitively prove that, we cannot just debate edge cases. We must take this framework and apply it to the most fiercely debated, heavily scrutinized macroeconomic asset of all.
Which asset?
An asset where the concepts of hedge floors and structural bids are currently colliding on a massive global scale. Let us talk about gold.
Gold is the ultimate psychological trap for this framework.
Let me frame its historical supercycles first. If you look at the data from 1971, when the United States officially abandoned the Bretton Woods system and closed the gold window, to 1980, gold embarked on a massive supercycle. It rose roughly 18 times in value.
Driven by inflation panic.
Driven by the framework, there was extreme, desperate hedge demand against the total collapse of fiat currency purchasing power as inflation raged. Simultaneously, there was an extreme arbitrage re-rating as gold was finally allowed to float freely against the dollar.
And then what happened in 1980?
From 1980 to the year 2000, gold entered a devastating two-decade bear market, falling roughly 55%. Why? Because the Federal Reserve under Paul Volcker crushed inflation with exorbitant interest rates, the hedge impulse against fiat debasement went completely dormant. The floor vanished.
The cycle turned again in 2001?
From 2001 to 2011, the cycle turned aggressively. The September 11th attacks, the subsequent wars, the 2008 Great Financial Crisis, and the advent of quantitative easing brought monetary hedging violently back into the market. Gold rose 7 times in value.
And you are arguing we are in a new supercycle now?
Now, let us look at the present reality. From 2023 through 2026, gold has unmistakably entered what the smartest macro allocators recognize as a new supercycle. And the framework perfectly explains exactly why gold is behaving the way it is right now.
Because of the central bank buying?
We are witnessing an unprecedented structural bid. Central banks around the world, particularly in the BRICS nations, are aggressively diversifying their sovereign reserves away from the US dollar to protect themselves from the exact geopolitical weaponization of the dollar you just described in the Russian scenario.
They are buying gold in massive tonnage, completely price insensitive.
Alongside that structural bid, the hedge floor against structural long-term fiat debasement is universally recognized by retail and institutional investors alike as government deficits spiral out of control. The framework flawlessly maps the current gold reality. How is it a trap if the data supports it?
You look at the market. You see the massive structural bid from foreign central banks accumulating bullion. You see the retail hedge floor reacting to inflation headlines, and you automatically assume the asset is universally, fundamentally supported. You assume the price is justified.
The capital flow justifies the price.
But you are completely ignoring the hidden variable that your static engineering framework entirely omits, the dimension of time horizon. Discussing the price of an asset as though it is a single static object suspended in a vacuum is a severe analytical mistake.
Over short-term time horizons, capital flows absolutely dominate.
Structural bid drives the price action, yes. But over long-term, multi-year horizons, historical valuation and scarcity absolutely dominate. Let us break down the exact mechanics of valuing gold. Gold produces no cash flow. It pays no dividend. You cannot value it using a discounted cash flow model.
So how do we measure if gold is historically cheap or historically a bubble?
We use the ultimate macroeconomic thermometer for this asset, the gold to M2 ratio.
Define exactly what M2 is so we understand the mechanics.
Think of the M2 money supply as the total aggregate pool of liquid dollars floating around the entire United States economy. It includes all the physical cash in people's wallets, all the money sitting in checking accounts, all the money in savings accounts, and all the money parked in retail money market mutual funds.
It is the total measure of readily available purchasing power.
If the Federal Reserve and the Treasury flood that massive pool with new liquidity by printing money and running massive deficits, the finite assets floating in that pool, like a fixed supply of gold, should naturally float higher in dollar terms.
Therefore, the gold to M2 ratio measures the precise price of an ounce of gold relative to the total volume of fiat currency in existence.
Right now, as we analyze this market, gold is priced at roughly $4,593 per $1 trillion of M2 money supply. That puts the gold to M2 ratio exactly at 204.
Which is historically elevated.
Let us look at the historical regime map for this specific ratio because it dictates the entire life cycle of the asset. When the ratio falls below 80, history shows this is strong buy territory. Gold is radically undervalued relative to the amount of fiat currency in the system.
And the accumulation zone?
When the ratio sits between 80 and 120, that is the traditional accumulation zone. Between 120 and 160 is a steady, balanced hold. As the ratio climbs between 160 and 250, we enter the hot, extreme caution zone. Valuations are deeply stretched. Anything mathematically above 250 is an extreme historic mania.
We're sitting right now at 204.
Everyone looking at your framework assumes that the central bank's structural bid means gold is a perfectly safe haven today. The narrative is bulletproof. But let us look at the brutal reality of market history. When was the last time we saw gold to M2 ratio this high? Think about this. 1979. The ratio hit 208.
Right before a massive crash.
Right before a catastrophic 2-decade, 55% collapse in the price of gold. The tactical buyers who rushed into the market in early 1980, the people who ignored the historical valuation, who relied solely on the prevailing narrative of the unbreakable hedge floor and the structural bid of inflation panic, were utterly financially crushed.
That is a sobering data point.
Your framework tells an investor today that gold is structurally bid and safely protected. But the mathematical, historical reality is that at a ratio of 24, gold is highly cyclically vulnerable.
Even with the central bank buying?
The exact same asset that was a brilliant, generation-defining strategic hedge when the ratio was low in 1971 became a terrible, wealth-destroying tactical buy at the top in 1980. Your framework completely ignores the fact that an asset can be structurally supported by a narrative for a decade
while simultaneously being a mathematically dangerous overvalued allocation over the next 6 to 12 months.
That is a brilliant parsing of the data. And honestly, this is where our two divergent perspectives actually begin to converge. It leads us to the most crucial, actionable insight of this entire analysis.
How do they converge here?
You are absolutely correct that gold is cyclically vulnerable at a 2:4 ratio if we force ourselves to view it solely through the traditional singular lens of being a pure inflation hedge.
The standard market assumption about gold is entirely binary. The market believes that if inflation surges, gold wins. And conversely, if inflation falls and the economy cools, gold loses. That is the 1980 playbook.
But that binary assumption completely ignores the most critical mechanical shift in modern macroeconomics, the concept of policy convexity.
Unpack the exact mechanics of what policy convexity actually means in the current environment.
What is actually happening beneath the surface of the macro data? Think about the primary driver of global inflation: oil prices. When the price of oil spikes aggressively, global inflation expectations immediately rise. The cost of manufacturing, the cost of transportation, everything goes up.
In that scenario, gold acts as the classic traditional inflation hedge. Capital flows into gold to protect purchasing power.
But what happens in the opposite scenario? What happens when oil prices fall hard enough and demand collapses? The economic data deteriorates rapidly. Unemployment ticks up, manufacturing contracts.
In a traditional market, gold would fall because inflation is dead.
But we are not in a traditional market. We are in a regime of extreme financialization. When the economic data deteriorates hard enough, it immediately induces aggressive, reflexive easing from the central banks. The Federal Reserve panics about a recession and immediately begins cutting interest rates and signaling the resumption of quantitative easing.
And the moment the central bank signals that they are going to flood the system with liquidity to save the economy,
Gold immediately rises as a monetary hedge against the dilution of the currency. This is the definition of policy convexity. Gold is structurally bid on both sides of the macroeconomic spectrum. The framework holds, but the application requires a profound level of nuance.
So it wins if inflation is hot, and it wins if the economy breaks.
Gold is not a one-way inflation hedge. It is a policy convexity asset. It hedges against severe inflation stress on the way up, and it hedges against the massive central bank policy response on the way down.
That dual pathway explains a lot.
That convexity explains precisely why a historically elevated gold to M2 ratio of 204 can be structurally justified by the current macro environment, even as we fully acknowledge and respect the cyclical vulnerability you pointed out.
That is the most intellectually honest defense of the current valuation I have heard. If we accept that synthesis, that the triad of hedge, arbitrage, and structural bid is an indispensable first-pass filter, but becomes fatal, blinding dogma when investors assume continuous liquidity where there is rupture, then we have a responsibility to translate this intense theoretical debate into concrete, actionable portfolio reality.
We have to map this framework onto a multi-asset portfolio for the next 12 to 24 months. The underlying data we have debated demands rapid, highly specific allocation changes. We cannot just debate theory. We have to allocate capital.
Let us start with the centerpiece of our debate, gold. Given the policy convexity you outlined, the explicit mandate is to maintain an overweight position in physical gold, representing exactly 5% of the core portfolio.
However, given the terrifying historical precedent of the 2:4 ratio you highlighted, this position must be managed with extreme discipline.
It must be viewed as structurally bullish, but tactically cautious. Investors should hold the line here, but they must implement a strict, unemotional rule. Trim the position aggressively, selling down to a 2% weight the exact moment the gold to M2 ratio crosses the 250 extreme mania threshold.
Moving from commodities to real assets, the data dictates a specific overweight position in high-quality commercial real estate, but we must be surgical. We are not buying office buildings.
We are targeting high-quality industrial REITs.
Specifically prime logistics operators like Prologis, with a massive 7% overweight allocation. Why? Because this is an environment where the triad is genuinely visible, quantifiable, and currently functioning.
The hedge floor is driven by the premium replacement cost of the physical warehouses.
And a structural bid is driven by the relentless, irreversible corporate demand for e-commerce logistics and supply chain nearshoring.
However, tying back to the necessity of recognizing when the environment changes, strict risk management discipline is required. We must respect the macro data over the structural narrative.
You must cut that real estate exposure back to a neutral market weight immediately if national industrial warehouse vacancy rates rise above 6%.
Or if the 10-year Treasury yield jumps 50 basis points in a single volatile quarter, which would shatter the underlying arbitrage premium of the REIT yields.
To perfectly balance that offensive allocation, we must proactively address the extreme edge cases and tail risks you so effectively highlighted earlier.
To achieve true mathematical diversification in a portfolio, you cannot rely on equity and bond correlations that might go to 1 in a crisis.
Portfolios must add a dedicated 2 to 3% alternative sleeve strictly allocated to catastrophe bonds. Given their verified historical correlation of exactly 0.05 with the S&P 500, they provide genuine structural separation from equity market volatility.
They are immune to margin cascade liquidations in the banking sector. That position provides a massive, high-yielding anchor.
It should only be liquidated or cut if insured global natural catastrophe losses exceed $150 billion annually, which would signal a fundamental, permanent shift in the underlying actuarial climate models themselves.
Conversely, knowing what to cut from the portfolio is just as vital as knowing what to buy. We must aggressively underweight illiquid securitized assets by a full 7%.
We cannot afford to ignore the mechanical liquidity lessons of the 2007 quant meltdown and the LTCM collapse. Any asset that is heavily reliant on uninterrupted, highly levered arbitrage plumbing functioning perfectly during a crisis must be reduced.
Furthermore, we must underweight traditional energy equities by 5%. While oil remains a critical input to the global economy, the mechanics of inflation are shifting.
Oil is actively losing its monopoly power as the sole macroeconomic hedge catalyst.
In a world rapidly shifting toward copper-intensive electrification, massive grid infrastructure buildouts, and power system bottlenecks driven by artificial intelligence data centers, traditional hydrocarbons no longer command the absolute structural bid they once did.
We find ourselves arriving at a shared verdict. The theoretical framework of a hedge floor, an arbitrage premium, and a structural bid remains an indispensable, deeply insightful first-pass filter for analyzing liquid public markets.
It brilliantly explains why defensive sectors outperform late in the business cycle, why passive index inclusion flows dramatically alter stock valuations, and why relentless central bank accumulation can sustain elevated pricing in sovereign debt and gold.
But the line is drawn clearly. The framework crosses the line into fatal, destructive dogma, the absolute moment investors assume continuity where there is systemic rupture.
It fails the moment allocators model mathematically monetizable arbitrage in a market where there is only theoretical mispricing and zero underlying liquidity. The framework perfectly describes the market. It does not and cannot control it.
As we look at today's tightly wound markets, with valuations stretched and geopolitical fault lines deepening, the question isn't whether the structural bid exists right now. We know it does. The question is, when the next liquidity freeze hits, which of today's deeply trusted, beautifully engineered pricing models will instantly revert from a fundamental law of gravity back into a mere vocabulary?
This is the Research Desk officially signing off.